In the world of investing, few names command as much respect as Charlie Munger. While Warren Buffett is widely recognized as the face of Berkshire Hathaway, Munger has been the firm's philosophical backbone, its strategist, thinker, and disciplined decision-maker. Known for his deep wisdom, sharp wit, and ability to see value where others see ruin, Munger built a legacy as one of the greatest investors of all time. But what truly set Munger apart was his willingness to make bold, contrarian bets, investments that seemed outright foolish to the average investor but, under his lens of rationality and deep analysis, revealed hidden potential. One such bet stands out in his long and storied career, his investment in Blue Chip Stamps, a company that many thought was doomed. This is the remarkable story of how Charlie Munger defied conventional wisdom, took a massive risk on a struggling company, and turned it into one of the most brilliant investments of his career. A failing business in a changing industry. To understand this investment, we have to go back to the 1970s, a time when trading stamps were a major part of retail businesses. The concept was simple: consumers would receive trading stamps when they made purchases at participating retailers. They could collect these stamps and later redeem them for merchandise from a catalog. It was a loyalty program before loyalty programs became digital and ubiquitous. One of the biggest names in the trading stamp business was Blue Chip Stamps, which had a stronghold in California. The company had once been immensely profitable, dominating the loyalty rewards industry. But by the time Charlie Munger and Warren Buffett took a serious look at it, the industry was on the decline. The reasons were clear. Changing consumer behavior, shoppers were beginning to prefer direct discounts over collecting stamps for future rewards. Retailer disinterest, many retailers started abandoning the trading stamp model in favor of simple price reductions. Operational struggles, Blue Chip Stamps was losing customers and revenue at an alarming rate. By all appearances, it was a dying business, the type of company most investors would avoid like the plague. Why Munger saw opportunity where others saw ruin. Most investors wouldn't touch Blue Chip Stamps with a 10-foot pole. But Charlie Munger wasn't like most investors. He didn't just look at the business as it was, he looked at what it could be. Munger had a unique ability to separate the financial structure of a company from its core operations. He saw that while the trading stamp business was deteriorating, the company itself had a significant pool of cash and liquid assets that weren't being utilized properly. More importantly, Blue Chip Stamps had one thing that was incredibly valuable: control over cash flow. Since customers had already purchased stamps that had not yet been redeemed, the company had a floating capital that could be used for investment before obligations needed to be paid. This was eerily similar to another concept Munger and Buffett loved, the insurance float model that fueled the success of Berkshire Hathaway's insurance operations. If Munger could redirect this cash into high-quality investments, Blue Chip Stamps could become a goldmine. And so, against the skepticism of the market, Munger bet big. Charlie Munger's decision to invest in Blue Chip Stamps wasn't just about seeing untapped potential. It was about having the vision to redirect its financial resources towards something far greater. At the time, most investors only saw a shrinking business model. But Munger and Buffett saw something else entirely. A massive cash reserve that could be reallocated to more profitable ventures. This wasn't a gamble. It was a strategic move grounded in Munger's deep understanding of capital allocation. The power of the float, Blue Chip's secret weapon. One of the most important financial principles in Buffett and Munger's investment philosophy is the float. The ability to use money that technically belongs to someone else but isn't immediately needed to pay obligations. Insurance companies are a prime example. They collect premiums from policyholders and only have to pay out claims when necessary. In the meantime, they can invest that money, generating significant returns before paying it out. Blue Chip Stamps worked in a similar way. Customers would buy trading stamps from the company, but those stamps wouldn't be redeemed right away. Some would never even be used at all. That meant Blue Chip had a substantial amount of cash sitting idle, cash that Munger and Buffett could use for investments long before it ever needed to be paid out. Munger and Buffett take control. By the early 1970s, Munger had acquired a major stake in Blue Chip Stamps, and Warren Buffett soon followed. Together, they gained significant influence over the company's decisions. Rather than pouring money back into the fading trading stamp business, they began redirecting funds into more promising investments. Their strategy was simple but incredibly effective. Use the float from Blue Chip Stamps to buy shares in great companies. Let those investments compound over time. gradually transformed blue chip from a dying business into an investment powerhouse. One of the first major investments they made. See's Candies. See's Candies. A sweet deal. In 1972, Munger and Buffett used blue chip stamps to buy See's Candies for $25 million. At the time, many thought they overpaid. But what Munger and Buffett recognized was that See's had an incredibly strong brand, pricing power, and customer loyalty. Even though its revenue wasn't skyrocketing, it generated consistent, reliable profits year after year. Over time, See's Candies became one of Berkshire Hathaway's most successful investments, producing hundreds of millions in profits that helped fund even more acquisitions. And the beauty of it all? It was blue chip stamps money that funded the purchase. The compound effect begins. Munger and Buffett didn't stop at See's Candies. They continued to use blue chips float to invest in high-quality businesses, including a growing stake in the Washington Post and other companies that would later become Berkshire Hathaway cornerstones. What had once been a failing trading stamp business was now a financial vehicle for compounding wealth. Blue chip stamps, once written off as obsolete, was now fueling a multi-billion-dollar empire. As the 1970s rolled on, Charlie Munger and Warren Buffett continued their masterful transformation of blue chip stamps. What had started as an aging, declining business was now a powerful investment engine, redirecting its financial resources into some of the most lucrative businesses of the century. But their work wasn't done yet. By 1977, Munger and Buffett had acquired enough control to dictate the company's future. And with every new move, blue chip stamps was becoming less about trading stamps and more about strategic capital allocation. This chapter of the story is where things really took off. The Washington Post, betting big on media. One of the most remarkable investments that Munger and Buffett made with blue chip stamps capital was in the Washington Post. At the time, the newspaper business was considered stable but unexciting. Many investors overlooked it. But Munger saw something different. He and Buffett believed that the Washington Post was massively undervalued. It had a strong brand and loyal readership. It had pricing power over advertisers. It had a virtual monopoly in its region, giving it a moat against competition. Munger understood that great businesses weren't just about short-term profits, they were about long-term dominance. So, in 1973, using money from blue chip stamps, Munger and Buffett invested heavily in the Washington Post company, acquiring shares at bargain prices. At first, the market didn't understand the move. The newspaper industry wasn't exactly booming, and some saw it as a boring, old-fashioned business. But over time, the investment paid off tremendously. Within a decade, their investment had multiplied many times over, eventually becoming worth over $1 billion. This was yet another example of Munger's brilliance, finding high-quality businesses, buying them when no one else wanted to, and letting compounding do the work. A shocking turn, Munger's personal bet on blue chip stamps. While Munger and Buffett were using blue chip stamps cash to fund investments, Munger made a bold personal decision. He went all in on the company itself. He personally bought shares in blue chip stamps, investing much of his own fortune into a company that Wall Street had given up on. Many people thought he was crazy. After all, the trading stamp industry was still fading, and blue chip's core business was slowly collapsing. But Munger didn't care about the trading stamp business. He cared about what blue chip stamps was becoming an investment powerhouse. And he was proven right. Over the years, as blue chip's investments in See's Candies, the Washington Post, and other businesses skyrocketed in value, the stock price of blue chip stamps soared. Munger's personal investment turned into an enormous fortune, further cementing his legacy as one of the greatest investors of all time. But the best was yet to come. By the late 1970s, blue chip stamps had completely transformed from a dying trading stamp business into a powerful investment vehicle. Thanks to Charlie Munger and Warren Buffett's strategic decisions, its cash reserves had been used to acquire legendary businesses like See's Candies and the Washington Post, proving that brilliant capital allocation could turn even a failing company into a goldmine. But Munger and Buffett weren't done yet. The final step in this remarkable journey was integrating blue chip stamps into Berkshire Hathaway, solidifying its place as part of one of the most successful investment conglomerates in history. The slow takeover of Berkshire Hathaway. At this point, Munger and Buffett controlled a majority of blue chip stamps, and its cash-generating investments were fueling the growth of Berkshire Hathaway. The trading stamp business itself was barely relevant anymore. What mattered was the company's investment portfolio and cash reserves. So what did Munger and Buffett do? They began shifting blue-chip stamps assets into Berkshire Hathaway, step by step. Berkshire Hathaway was already becoming Buffett's primary investment vehicle, and bringing blue chip into the fold made perfect sense. The process was gradual, but over time, blue chip's stake in companies like See's Candies and the Washington Post became part of Berkshire Hathaway's empire. Eventually, by 1983, the integration was complete. Blue chip stamps ceased to exist as an independent entity. Everything it owned was now part of Berkshire Hathaway, and its original trading stamp business was left behind. Munger's masterstroke, a lesson in contrarian thinking. What made Munger's investment in blue chip stamps so legendary was that it was completely contrarian. Think about it. He invested in a company that was in decline. He ignored the fact that its core business was fading away. He focused instead on its cash reserves and capital allocation potential. While the rest of the market saw a dying business, Munger saw an opportunity to redirect resources into better investments. This is one of the greatest lessons in value investing. Backhand index pointing right, a company's value isn't just about what it does today. It's about what you can do with its resources in the future. This same thinking is why Munger and Buffett were able to turn Berkshire Hathaway itself from a failing textile business into a global investment powerhouse. Blue chip stamps was simply a smaller version of that same story. A company that didn't have a future in its original business but became incredibly valuable once its resources were put to better use. And Munger saw it before anyone else did. The payoff? How much did Munger and Buffett make? By the time blue chip stamps was fully absorbed into Berkshire Hathaway, the value of its investments had multiplied many times over. See's Candies, which had been bought for $25 million, has since generated over $2 billion in profits. The Washington Post investment, made for $10 million, eventually grew to be worth over $1 billion. The stock price of Berkshire Hathaway, which Munger and Buffett had been accumulating, has skyrocketed from hundreds of dollars per share in the 1970s to over $500,000 per share today. For Munger, his personal stake in blue chip stamps turned into a fortune worth hundreds of millions of dollars, proving that his contrarian thinking and long-term vision had paid off in ways that few could have imagined. But more than the money, this investment cemented Charlie Munger's reputation as one of the greatest investors and capital allocators of all time. Charlie Munger's investment in blue chip stamps was more than just a profitable trade. It was a masterclass in value investing, capital allocation, and long-term thinking. His ability to recognize potential where others saw decline was a defining moment in his investment career and played a crucial role in shaping Berkshire Hathaway's rise to dominance. But what lessons can we take from this legendary bet? Munger's investment principles from the blue chip stamp story. Charlie Munger wasn't just a great investor, he was a philosopher of business and finance. His approach to investing was built on fundamental principles that were clearly demonstrated in the blue chip stamp strategy. Here are the biggest takeaways. 1. Look beyond the surface. At first glance, blue chip stamps looked like a terrible investment, a fading business model with little growth potential. But Munger saw what others didn't, a hidden asset in the form of an investment float. Backhand index pointing right lesson. Don't judge a company based on its current business alone. Look at what its assets and capital can become in the right hands. 2. The power of float and capital allocation. The key to blue chip stamp success wasn't its trading stamps. It was the cash reserves that those stamps generated. Instead of reinvesting in a dying business, Munger and Buffett channeled the money into high-quality investments like See's Candies and the Washington Post. Backhand index pointing right lesson. Smart capital allocation can turn even a struggling company into a compounding machine. 3. Buy wonderful businesses at fair prices. See's Candies was one of the first investments Munger and Buffett made with blue chip stamps money, and many thought they overpaid. But See's had something more important than just a low price. It had a strong brand, pricing power, and loyal customers. Backhand index pointing right lesson. It's better to buy a great business at a fair price than a mediocre business at a cheap price. 4. Ignore short-term noise. Focus on long-term gains. When Munger and Buffett bought the Washington Post, many investors ignored or dismissed the newspaper industry. But they weren't thinking about the next few quarters, they were thinking about the next few decades. Backhand index pointing right lesson. The best investments take time. Ignore short-term negativity and focus on long-term fundamentals. 5. Be a contrarian when the facts support it. At every stage of the blue chip stamp story, Munger went against the conventional wisdom. He invested in a dying business when others were selling. He personally bought more shares when people doubted the company. He used its float to invest in businesses that others overlooked. And because he was right, this single bet helped build the foundation of the Berkshire Hathaway empire. Backhand index pointing right lesson. The best investment opportunities often look crazy at first. But if the numbers and logic support your decision, go against the crowd.